Hello and welcome to Cryptobasistrade, a platform that provides you with tools to invest in a strategy called basis or carry trade and hedge your crypto investments. A basis trade is a well-known arbitrage strategy that allows you to earn a fixed return while protecting the dollar value of your investment. If you are not familiar with this concept, we recommend you to watch a short tutorial in the How To section of our website. To get started, head to your profile page. You first need to connect your account to supported cryptocurrency exchanges. The platform currently supports Kraken Futures, and Binance Futures Exchange. To connect, generate API keys in your account settings on the relevant exchange. If you need help with this, please refer to the support pages of the exchange or the How To section of our website. Note that the API keys generated on the relevant exchange should have reading and trading permissions. For security reasons, make sure to disable withdrawals permission when generating the keys. Some crypto exchanges, such as Binance, require the user to whitelist specific IP addresses for use with API keys that have trading permissions. Here, you can generate your IP addresses on the platform. Copy the IP addresses and whitelist them at the exchange when creating API keys. Once you have the keys, add them here. Let's add our keys for Kraken Spot, Kraken Futures, and Binance Futures Exchange. You don't have to have an account at all supported exchanges, but you need at least one spot and one futures exchange to implement the basis trade. Note that all actual trades to establish, roll over, or exit your arbitrage position take place on connected exchanges, and our platform only acts as an interface for executing these trades. If you experience any issues using the platform, you can check the logs to see if these are related to connected exchanges, such as incorrect API keys, insufficient funds at the exchange, and so on. Next, we will add our wallet addresses. If you keep all or some of your coins off exchange in a software or hardware wallet, you also need to add your public keys to the profile. That way, you would have the full view of your crypto balances both on and off the exchanges. Let's add our public keys for Bitcoin and Ethereum blockchain. You can add multiple addresses for each cryptocurrency. Now that you have connected the exchanges and added wallet addresses, you are ready to use the platform. You can access it in the dashboard section of the website. The two main tools that you will use to monitor and manage your arbitrage positions are Portfolio Dashboard and Trader. Let's start with Portfolio Dashboard. The dashboard consists of three sections: a section at the top showing the composition of your portfolio, a section in the middle that helps you add a new investment, and the section at the bottom detailing your outstanding positions in futures contracts. First, let's look at the portfolio section. This section aggregates users' balances on connected exchanges as well as in blockchain addresses added to user profile. The Exchange tab shows the breakdown of the portfolio between different exchanges and addresses. The Currency tab summarizes portfolio by cryptocurrency. It also shows the coin amount and the dollar value of unhedged positions. Here, we can see that the user chose to keep all of their Bitcoin holdings worth approximately $345,000 unhedged. They fully hedged their Ether holdings and kept around half of Litecoin holdings unhedged, with an open position totaling approximately $6,000. The total value of unhedged positions is about $351,000. The chart on the right gives an overall view of portfolio's price exposure. Here, around 60% of the portfolio is unhedged and represents an active long position. An active long position means that the portfolio has a positive price exposure and its value increases when crypto prices go up and decreases when they go down. It is also possible to have an active short position with negative price exposure. As we can see, The remaining 40% of the portfolio is hedged. By hedging, the user locked in the dollar value of this part of the portfolio. It is that part which generates carry returns. If the portfolio was hedged when futures spreads were positive, the value of the hedged portion will increase when the futures contracts approach their delivery date. Now, let's look at the new investment section of the dashboard. This section helps you add a new investment. You can choose to view a specific cryptocurrency or all contracts. Press View Contracts to review in real time all available futures contracts and the percentage return that you could earn by investing into them through the basis trade. Here, we can see that a basis trade using coin margin Bitcoin futures for June at Binance would yield an absolute return of 1.8% or over 11% on an annualized basis. Pressing the Invest button will bring up the Trader tool to establish an arbitrage position. Now, let's move on to the next part of the dashboard. The section at the bottom summarizes all outstanding positions in futures contracts. All positions are grouped by underlying cryptocurrencies. You will have a separate tile for each cryptocurrency where you have an open futures position. A tile summarizes all futures positions that you hold in a specific cryptocurrency and compares them to your spot position. Here, the user has a short position in futures contracts with Ether as an underlying asset. The position is held both on Binance and Kraken Futures Exchange. The futures column shows the number of futures contracts bought or sold. A positive number, as shown here, means that the user has sold futures and consequently has a short futures position. This is the most typical scenario since the basis trade involves buying the underlying coin spot and shorting it in the futures market. You can also take a long position in futures, in which case the tile would show futures contracts as a negative number. The next column shows a coin equivalent of the futures position. It is simply the nominal value of the position in US dollars divided by the mark price of the relevant futures contract. This metric is used to establish the equivalence of the spot and futures position for arbitrage. The remaining column shows the time remaining until the maturity of the contract. As the contracts approach their delivery date, you may want to either exit your arbitrage position or roll over the contracts for the next period. The buttons here help you do exactly that by bringing up and pre-populating a trader interface. You can also check out the details of each contract. In particular, you need to be aware of the liquidation price and the safety margin on your futures position. The liquidation price is the price of the futures contract at which your position will be liquidated. It is determined by the margin requirements of the relevant futures exchange and the amount of spot coins that you deposited as collateral in your futures account. The safety margin tells you how far the liquidation price is from the current mark price. The row at the top shows several key metrics. This field aggregates coin equivalent across all futures positions. This metric is compared to your actual spot coin position on and off the exchanges to determine the extent to which the position in a particular coin is hedged. The amount of the unhedged position is shown at the bottom of the tile. An unhedged position with a positive number means a positive price exposure, while a negative number means a negative price exposure on the relevant number of coins. Here, the user has a very small unhedged amount, essentially meaning that their Ether portfolio is fully hedged. Next, this amount shows the total nominal value of all futures positions in Ether. In a fully hedged portfolio, this number represents the value that the portfolio would have by the futures delivery date. The number next to it is the current value of the Ether portfolio. In a fully hedged portfolio such as here, you can calculate the expected dollar return on the strategy by subtracting the current value of the portfolio from the nominal value of the futures position. In this case, $219,000 minus $215,000 implies an expected return of approximately $4,000. This return will be realized in 1.9 months when the futures contracts approach their delivery date. Next, let's have a look at the Trader tool. The Trader tool is used to enter, roll over, and exit arbitrage positions. There are several ways to access it. If you're looking to exit your existing arbitrage position or roll it over, head to the Tile section where you can find the Exit and Rollover button. If you want to establish a new arbitrage position, go to the New Investment section of the dashboard, choose your contract, and press the Invest button. The Trader tool interfaces with connected exchanges and allows you to place trades. When you launch it, the tool will be partially prepopulated depending on the context from which it was called. You can choose or modify parameters as needed. Normally, the Trader is used to place trades in two different instruments. For example, if we want to create a new arbitrage position in Ether, we could buy spot Ether on Kraken and sell Ether futures on Binance. Or, if we already have a position in Ether futures and need to roll it over, we could buy back our shorter dated futures and simultaneously sell longer dated futures. In each case, both legs of the trade should be equivalent. When establishing an arbitrage position, the long spot leg should be equivalent to the short futures leg. Similarly, when rolling over the futures contracts on the same or different exchange, the longer dated futures leg should be equivalent to the shorter dated one. The Trader enables the equivalency by calculating the required number of contracts or coins in real time. Also, both legs of the trade must be completed simultaneously to avoid price exposure in between the trades. The Trader achieves that by placing the trades at the same time and using market orders. Let's say we want to invest 15 Ether into a basis trade. Check the cryptocurrency, exchanges and instruments, and modify them as needed from the drop-down menus. In our example, we want to buy spot Ether on Kraken and sell June Ether futures on Binance. Check that the sides of the trade are correct. Sell for futures and buy for spot in this case. Set the amount to invest. Choose contracts if you'd like to set the notional US dollar amount of your futures position, or coins if you would prefer to express the amount in spot coins. In each case, the Trader calculates the required number of futures contracts and spot coins for both legs of the trade to be equivalent based on real-time pricing data. Let's press OK. The Trader presents various metrics relevant for the basis trade. The basis is the ratio between the effective spot and futures price, while the nominal is the basis after deducting bid-ask spread. In effect, the nominal rate shows you the absolute rate of return you can expect to realize by entering the trade for the duration of a given futures contract. Here, about 1.8% until 30th of June 2023. The field below shows this return in annualized terms. You can change the inputs at any time by pressing the Edit button. Let's move on to trade mode controls. As previously discussed, entering, rolling over, and exiting the basis trade requires to trade two instruments simultaneously. This is the default option here. However, the Trader also gives you the possibility to trade only one instrument. You can specify the instrument and other details in Ticker 1 fields. The Ticker 1 trade mode could be useful, for example, if you have an unhedged position in your portfolio and want to adjust it by increasing or decreasing your futures hedge. Let's review other trade options. When performing a two-leg trade, you may choose to execute it immediately or try to optimize your return. Note how the effective price for both instruments and the spread between them changes constantly. The spread will determine your return in the basis trade. You can set this option to market and let the trader place orders immediately, or you can set the minimum spread here so that the orders are placed only when the minimum is reached. Note that regardless of whether it's the market or limit trade mode, the trader will always place market orders to ensure immediate execution and avoid price slippage. To place the orders in the market trade mode or stop the limit trade mode, press the Trade button. You can cancel the limit mode at any time by pressing the Cancel button. We can now close the Trader and return to the dashboard. This concludes our overview of the Cryptobasistrade platform. We have briefly looked into how to get started with the platform, its main features and functionality. For additional information and tutorials, make sure to visit our website's How To section. Thank you for watching.